Sorry guys, I got cut off a little bit in my last video. I'm just going to continue on this loans, just a little bit more about the loan. If we need to edit it out, we can. But warranty, so there are warranties on the equipment. Most our equipment has a 25-year warranty. Panels, inverters, 25-year warranty. We'll replace it. It's technically a 25-year on the panel, 20-year on the inverter, right? So people know that, and they warranty their workmanship, obviously. It's just a little different in the fact that a PPA or a lease, they literally take care of, I mean, kind of the same, it's almost the same, but they're literally fully responsible, where with a loan, the person owns it, so they have warranties and workmanship and stuff like that, but it's their product, right? They're not going to worry as much about it functioning 100% correctly. But again, they monitor it. So with a lot of these companies, they monitor the production. With a PPA, a lease, a loan, they monitor the production. They see that it's working correctly, that it's producing the power they need, all that stuff, so they can see if something's wrong, right? Obviously a panel might not be functioning, an inverter might not be functioning, something might be going on that is just not making it possible for it to do its job 100%, right? So that's the whole purpose behind them monitoring it and you being able to monitor it. Generally they put a separate meter outside the house for the customer to go around and look at what the production is, right? So again, with the loan, a little different from the PPA or the cash. Again, with the cash, you still get the tax incentives. So if it's $30,000, you still get those tax incentives. They usually go into your pocket, whereas the loan, those tax incentives are generally applied to the loan to lower your payment, right? So again, it's just different ways of approaching it, and I'm sure there will be more to come as far as the differences go between a lease, a loan, and a cash purchase or a lease as well. So now from that, those are kind of the basics of how it works. Now again, with the tax credits, just to kind of give an overview a little bit of that, there's a 30% tax credit. So they give you right now, and again, this is said to change. Is it December 2016 when it lowers? To be honest, I haven't thought about it in a while, but let's just say it is. It's going to go down to 10%. So 30% of the system cost, right, is refunded as a tax incentive or a tax credit. It goes down to 10% in December 2016. Sometimes there's state incentives, sometimes there are not state incentives. Now, people ask, okay, so how do I get a tax incentive? How do I get a tax credit or whatever, right? A lot of this stuff, you don't need to deal with a ton as like a lead setter. But nonetheless, with closers and things like that, you will need to know. So how they do it, it's pretty simple. Say at the end of the year, if they own a business or they pay taxes, say they pay $10,000 in taxes, right? I don't know what they pay, but say they do. Say they have a $5,000 tax credit. Usually a state incentive is just a check. Simple, right? It's sent to you. It takes a while, but it's sent to you. So obviously, instead of owing the government $10,000, they would now owe them $5,000, right? Because they had a tax incentive or a tax credit. So these tax credits are not write-offs. They're not like, oh, I have a business and I use write-offs. These are tax credits. That means they're as good as cash in your hand, okay? Now, with that tax incentive, if I lost my train of thought there, 10,000, 5,000 for a tax incentive, 5,000. Oh, there's where I'm at. What if you get a tax return? Say the government pays you $2,000, $3,000 at the end of the year. So let's say I get a $3,000 tax return for my job. Well, the reason you got that tax return is because you claimed on your, your W-2 that you're going to pay taxes throughout the year. So every time that check comes, they're taking taxes out, right? So say at the end of the year you get a refund because you've paid so much in taxes, right? Say you paid I don't know, $8,000 in taxes, but you overpaid $11,000, so they give you a $3,000 tax return. Say you have a $5,000 credit, right? from the government. So what would that mean? When you get your tax return, it's going to be $5,000 bigger, right? So you're going to get an $8,000 tax return. Now again, a lot of times with the loans, to lower their payment, they will apply that tax return to the loan to lower the payment. Or they can just take it and it's as good as cash, but their loan payment's going to be higher. Again, those tax credits do apply only to a loan or a cash. They do not apply to a lease and a PPA. The company would capture that tax credit and apply it themselves in order to lower their rates. So that's a little bit on the difference between a lease, a PPA, a loan, and cash. We'll go into a little bit more detail on that, and then just a little bit on the tax credits and how they're given. One last thing, if a customer asks how they get it, there's a form that generally their accountant should have, or they can contact us, and we will fill out the form, do all the paperwork, and send it to their accountant or whoever they use for their taxes. So again, that's a little bit on that. So thanks, guys.